Insurance, it's a word we hear all the time, right? It's probably a bill a lot of us pay every single month, but if you really step back and think about it, it's one of the most amazing ideas we've ever come up with. It's the system we built to look at a totally uncertain future and say, yeah, we've got a plan for that. Okay, let's really get into this.
To really get a handle on it, let me ask you something kind of terrifying. What if you lost everything? I mean, your home, your car, your ability to make a living. How in the world would you start over? See, that is the fundamental problem of risk that every single one of us has to deal with.
I mean, life is just so unpredictable. One minute, you're just driving along, listening to music, and the very next, bam, a sudden accident. It's a personal disaster that can happen to absolutely anyone, anytime, and the financial fallout can be huge.
And sometimes the risk is way, way bigger than just one person. Think about a natural disaster, a hurricane, a flood, a wildfire. It doesn't just affect a single family. It can completely devastate an entire community, wiping out homes and businesses in the blink of an eye.
And then you get these truly unexpected, almost unbelievable events. Remember that U.S. Airways flight that landed on the Hudson River? It was a miracle. Every single passenger survived. But the plane itself, that multi-million-dollar piece of machinery, was a total loss. How does a company even begin to recover from something like that?
So, what if disaster strikes? I mean, this has been a central question for humanity for literally thousands of years. How do we protect ourselves from a future we just can't predict? Well, it turns out the answer is an idea that's pretty much as old as trade itself.
And that idea, it's actually incredibly simple. It's just sharing the risk. Instead of one person having to face a massive, catastrophic loss all by themselves, a whole group of people agree to share that burden. So if something terrible happens to one of us, we all chip in just a little bit to help them get back on their feet. It's a really powerful idea of mutual protection.
And we have been working on this problem for a long time. I mean, look at this. Way back in the 3rd millennium BC, Chinese merchants were already doing this. They wouldn't put all their valuable cargo on one ship, they'd split it up. Smart, right? If one ship went down, nobody was completely wiped out. Fast forward to around 1750 BC, and you've got the Code of Hammurabi, which had actual laws about sharing the financial loss of a ship. But the real game changer came in the 14th century in Genoa with the first real insurance contracts. Then, boom, the Great Fire of London in 1666 suddenly made everyone realize they needed to protect their property. And all of this eventually led to a little coffee shop in London in the late 1680s, run by a guy named Edward Lloyd, where merchants and ship captains all met up to basically invent the world's first organized insurance market.
So, from a coffee shop to a massive global industry, how did that happen? How did this ancient, simple idea turn into the super complex financial system we have today? Let's get into the mechanics of it. Okay, so at its heart, the modern definition is pretty straightforward. Insurance is basically a contract, a promise. You pay a fee, that's called a premium, to an insurance company, and in exchange for that fee, they promise to pay you back if something bad happens that's covered by your policy. You're basically transferring your personal risk over to them. And the process works like this. First, you and millions of other people pay your premiums. The insurance company takes all that money and puts it into one giant pot, a risk pool. Then, when you get into an accident or your house gets damaged, you file a claim. And finally, the insurer uses the money from that giant pool to pay for your loss. The whole thing works because, statistically, only a small number of people will actually need to file a huge claim in any given year. Now, this is where it gets really interesting. How do these companies actually make a profit? It's not just about hoping they collect more in premiums than they pay out in claims. That's called underwriting. There's a second, and honestly, a much more powerful way they make their money. And it's called the float. The float is that enormous pool of money, all our premiums, that the insurance company is just holding onto before it has to pay any claims. And they don't just let it sit in a bank account. They invest it in stocks, in bonds, you name it. They are making money on our money. Sometimes they can make so much from investing the float that they can actually turn a profit, even if their underwriting business loses money. It's kind of the secret sauce of the whole industry. But, okay, let's be real. A system built on predicting the future and trusting people, it's far from perfect. It actually creates a whole new set of really complex problems and conflicts of interest. The two biggest headaches for insurers are what we call moral hazard and fraud.
Moral hazard is kind of a subtle thing. It's the idea that, hey, because you're insured, maybe you're just a little less careful. Maybe you don't bother double checking if you locked your car because you know you're covered for theft. It's not malicious, it's just human nature. Insurance fraud, though, that's completely different. That's intentional, it's straight up deception, someone faking a car accident, or worse, deliberately damaging their own property just to get a payout.
And the system has also had some really serious, dark chapters. One of the biggest is something called redlining. This was a deeply discriminatory practice where insurance companies would literally draw red lines on a map around certain neighborhoods, almost always minority communities, and then just refuse to sell insurance there, or they'd charge way, way higher prices. And while that practice is illegal now, its legacy and the debates about what's fair when you're calculating risk are still very much with us today.
But the challenges for insurance are always changing. You know, the industry was built on figuring out physical risks, like fires and shipwrecks. But today, one of its biggest challenges is managing a totally different kind of risk, the enormous amounts of personal data it has on all of us. So this leads to the crucial question for the whole industry right now. In an age where data is literally everything, how can a business model this old adapt to all the modern rules about our privacy and security? I mean, think about it. Insurers today hold this treasure trove of our most sensitive personal information. And because of that, they have to navigate this incredibly complicated maze of data privacy laws, like Europe's GDPR or California's CCPA. These are basically massive rule books that say exactly how our data has to be stored, handled, and protected. And if they mess up, the fines are absolutely gigantic.
And this is where technology comes in to save the day, so to speak. Modern insurance companies are using cloud-based platforms to put all that policyholder data in one central, secure place. They're building these sophisticated systems for better data governance, creating what you might call a single source of truth. It just makes it so much easier to track information, prove they're following the rules, and, frankly, protect our privacy in a way those old paper-based systems never, ever could.
So from ancient merchants spreading their cargo across a few ships to modern companies using the cloud to protect our data, insurance has always had to evolve to meet the risks of the day. And that really leaves us with one final big question. As our world keeps changing, with new tech and new challenges popping up all the time, what on earth will we need to insure next?